quite resilient for the last 2 years, right? As you can see for the STI. But if you were to look at Asia Pacific and then looking at the US, you can see that the markets were quite volatile. Equity markets were up a lot in 2021 for US, for example, and then down a lot in 2022 subsequently. Now you look at global bonds, well, they haven't really been a safe haven because in 2021 they were down, and 2022 was a really bad year for bonds as well. So that's why I put in the comments that even the classic 60-40 strategy, this is the classic 60% equity, 40% fixed income strategy, has not been able to deliver for the past few years. And part of the reason why global bonds haven't been able to deliver, because when you talk about global bonds, typically people look at more longer maturity global bonds. Longer maturity means 10 those that have mature in 10 years, those that mature or even 20 years. So it comprises the whole spectrum. So long maturity bonds especially have been badly hit by rising interest rates over the past 2 years. As a result of the central banks being aggressive on inflation, they have been raising interest rates at the highest pace in 40 years, right? So from near zero interest rates in 2020, 2021, currently we are seeing, for example, 5% US dollar interest rates currently. So that has definitely hit the higher maturity global bonds, right? Because higher maturity bonds, as we'll see later, they have much higher interest rate risk compared to short maturity bonds, right? Lastly, if you look at gold and commodities, they have been, well, I guess, a bright spot in a sense. Inflation has benefited this asset class, right? So that's the perspective of the performance for the various asset classes for the last 2 years. Well, I just also, before we finish this slide, the 2023, right? Just to give you a narrative of the equity market so far, right? So 2023, the US markets have rebounded again, right? Asia Pacific has been disparate, mixed, right? Some markets have continued to strengthen, such as Japan, while others, such as China and Hong Kong, have actually continued to drop. Singapore actually has been sideways trading. You probably characterize it as sideways trading, up and down, going nowhere basically for the equity markets. That's for 2023. So that's the performance so far. If you look at the economic fundamentals, this is how things currently pan out. Inflation and interest rates have been dominating the narrative over the past 2 years, basically. The top chart shows the consumer inflation in the US. And you can see that, in 2021, 22, inflation had a sharp spike up to over 8% year on year. That is why the US central bank had to react very aggressively to raise interest rates so aggressively. Even though the inflation has tapered off recently, however, you will see that right now the narrative is that interest rates are set to be higher for longer. I guess it's not, the higher is maybe not so accurate, probably it's high for longer, meaning that the market mainstream expectations now is that interest rates have peaked. For the US at least, right? The Federal Reserve is at near the end of its rate hiking cycle, but it's not set to lower interest rates quickly over in anytime soon. So they are they're expected to maintain the current high interest rates for an extended period. And why is that? Why is that so? The main reason is because inflation is hard to tame once it arises, and it can be quite persistent. As it is, the current inflation is not driven by commodities. It's not driven by goods. It's not driven by COVID restrictions. That was the narrative 2 years ago during COVID when there were supply restrictions. But today, what is driving inflation today is a more sticky kind of inflation, that of wages, that of services, right? Services meaning, for example, retail, travel, professional services, logistics, that kind of inflation, which is harder and more sticky. It's harder to tame. So it is probably is correct to say that it was easier to bring inflation down from 8% to 4% as compared to bringing the current inflation now from 4% to target 2%. And that's because inflation currently is driven by sticky drivers. That is why the Federal Reserve has been coy about looking to lower interest rates from here. They will more likely keep interest rates high, even though they're not likely to raise it any further that much. The bottom chart basically shows the Singapore 1-month SORA. So I think many of you, if you take mortgage loans, will be familiar with SORA. It's one of the key benchmarks for mortgage rates currently, right? So right now, from near 0% in just 2 years back, right now that number 1-month SORA is closer to about 3.7% or 3.8%, right? So that's an indication of the interest rate environment we are in Singapore. Now, what does all this translate to? I think we need to be cautious about market risk, right? Market risk has over the past 2 years, the markets, equity markets, risk markets have been volatile, and the Federal Reserve and the central banks around the world have been raising interest rates at such a high clip, such an aggressive clip that if you were to look into the future already, if you were to look at economies such as Europe and parts of Asia such as China, you would have read the headlines. In fact, parts of them are already in contractionary mode, especially in parts of Europe and China, right? So that is why in the US, as the economy continues to be quite resilient, but even then recently we have been seeing that there is signs of slowing down, especially in the services sector. Globally, in fact, the manufacturing sector, the goods sector has already been in contraction for the past few months, March of 2023 actually. So that is why we probably need to be cautious of recession. And when you talk about risk, you also want to be careful about currency risk, which is what I'm showing here. When you invest into, say, if you want to invest into US equities, US bonds, there is a currency risk involved, right? And that currency risk is if the US dollar, for example, weakens against the Singapore dollar. So even if, say, you get 5% back into US dollars bonds, but when you translate back to Sing dollars, if the US dollar strengthens, it weakens 2% against the Sing dollar, then what you eventually get is just a 3% return, for example, right? And in fact, if you look at Singapore dollars, which is our natural currency exposure anyway, right? It is not a bad currency to be in at all, because the long-term track record for Singapore dollar has been about strengthening of 1% average per year against the US dollar over the past 30 over years since 1990. This is what this chart is showing. From one Sing dollar buying 0.55 US dollars in the early 1990s, now 1 Sing dollar is able to buy 0.75 US dollars, right? So that translates to about 1% per year strengthening against the US dollar. What I'm trying to show here, therefore, is that first of all, economically, we probably need to be a bit more cautious and defensive because of the high interest rates and already slowing down in parts of the global economy. And secondly, if you wanted to invest, probably the Singapore dollar itself is a currency that you may like to be in because of its long-term track record. Right? That brings us to the Sustainable Reserve Fund, which is the main topic of today. So the Sustainable Reserve Fund is basically a short duration bond fund, right? short duration, or you can duration or short maturity bond fund. Duration and maturity, they are used interchangeably. What it means is basically invest into short maturity bonds, and part of it also possibly to fixed deposits, right? So what's the key advantages? So basically low interest rate risk, right? And also because of the high interest rates environment currently is also able to give you quite attractive income, right? Hence the irregular income focus. And on top of it, we believe this is the only retail fund in the Singapore market where the short duration bond fund also has ESG, is also an ESG fund, right? And basically this ESG fund is it is why we name this fund the Sustainable Reserve Fund. So the sustainable part of the name is referring to the ESG status of this SRF fund, Sustainable Reserve Fund. And that incorporates our sustainable investing philosophy under Philip Capital Management. What does this fund aim to achieve? So I think this would be what you're looking for. Yields that are higher than typical money market, right? So probably if you put your money into fixed deposits, currently you can get maybe 3% is already a very good return, right? So this fund, as I'll show you later, is able to achieve a slightly higher yield than that. Okay, low volatility. So on top of the high attractive return, it is on top of that, the risk of this fund is considered low. So low volatility or low risk returns, right? So the price of the fund is not expected to fluctuate in a big manner compared to normal, say, higher maturity bond funds or compared to normal equity funds, right? And the reason why is because again, it is a short maturity bond fund or short duration bond fund. I'll explain later how that translates to low volatility returns. Lastly, for those of you who want to do good as well as do well for your investments, so this is a fund, this ESG fund is able to target for positive impact for a sustainable economy. How does the fund try to achieve its low interest rate risk and regular income focus, right? So this is how it tries to do that. Basically, it will be investing into short-term bonds, but at the same time, we will make sure at the point of buying, it will be investment-grade bonds, right? So that will provide above average. It will provide returns that are above the fixed deposits typically, and also stability of income because it's short-term bonds. Okay, ladder investment means that whenever the short-term bonds mature, say a short-term bond, say a three-month short-term bond, when it matures after 3 months, we get the principal back. We will reinvest continuously into new bonds. Okay, and the portfolio will spread over a range of maturities for bonds. So the portfolio, because of economies of scale, right, we are able to buy a range of bonds in the portfolio at any one time. It could be one of the bonds could be a short, say 3-month bond, Sing dollar bond. Then the second bond could be a 1-year Sing dollar bond, and then a higher maturity bond, say a 3-year Sing dollar bond, all within the same portfolio. So that's what we mean by ladder investments. It will be investing over a ladder of bond maturities, but ultimately targeting a shorter maturity overall portfolio. Right. So we will be focusing on quality companies, right? So the issuers would typically be familiar names, right? So could be CapitaLand, it could be some of the GLCs you are familiar with, right? Corporates, quite a number of the investments will be corporate bonds, but high quality corporate bonds, familiar names, right? Investment grade status. Okay, and there could be possible investment into non-Singapore dollar bonds, right? But we would typically hedge the forex risk, meaning that we will try to manage such that the currency risk exposure is minimal. Right. Lastly, we intend to have a distribution policy. So for this fund, the retail classes, there is the A class, there is an A class accumulating, meaning that there is no distribution, or you can opt for the A class distributing class, which is the A class, the retail class that has a distribution policy. And for this particular class, you will be looking to distribute every quarter. Okay. Lastly, focus on resilient business model, i.e. ESG considerations, right? ESG, for those of you who are not familiar, stands for environmental, social, governance, right? Basically, it is trying to target those issuers and bonds, which would rank higher on a ESG ranking, right? Okay. That means basically those that score higher on environmental scores, on social scores, and governance scores. I will explain later in the last section about why ESG is a way of additionally screening for long-term risks. Okay, but first of all, coming back to this fund, what is it suitable for? It is suitable for investors who have a slightly longer term investment horizon. Just slightly, because you are not going into like long-term bonds, for example. But in the nature of this short duration bond fund, it is going to be investing into bonds which are of shorter maturity anyway, right? But at the same time, it is able to generate reasonably better returns than, say, money market funds, money market instruments, right? Or fixed deposits for that matter. And basically, for those who want to get some regular income, those looking to invest responsibly, and lastly, those you would like to invest with moderate risk exposure. Now, to characterize this sustainable reserve fund, how does it fit along the risk spectrum? Now, if you were to characterize various kinds of funds across a risk spectrum from 1 being lowest to 10 being highest. So, for example, narrowly focused country equity funds, stock funds, investing into single country stocks, that would be typically on the higher end, say, rank a risk score of 10, right? Risk spectrum 10. And on the lowest end, money market fund, that would basically be at the lowest end of that risk spectrum at 1. So if you were to characterize a short duration bond fund, a $dollar short duration bond fund, I would say that it's somewhere around 2, right? So it's just one step up from money market fund, essentially, in terms of the risk. Okay, so that is why we say for this fund, it is suitable for those who look to invest with moderate risk exposure. Okay, so this is just a quick snapshot of the expected portfolio at so we are currently still investing for the fund. It has already started and you are able to subscribe. So we expect that the portfolio is going to be majority into investment grade corporate bonds, which is the dark green portion, 70%, and then a quarter of it expected to be in fixed income. Into fixed deposits, right, 25%, and lastly, some cash for liquidity purposes. In terms of credit profile, the exposures of the fixed income securities that we invest into, you can see that, all of them we expect to be investment grade. That means triple B and above. Okay, the portfolio average yield is expected to be about 5%, right? So if you were to take the management fee away, then you would end up with something in the region of 4 to 4.5%. That is the expected yield for the portfolio that the end investor you would expect to get, right? Basically, average maturity is about slightly more than 1 year, 400 days, right? And for the distributing class A, you will see that is looking to distribute every quarter. Just a bit about this overall information about the fund. So, just a reference performance benchmark is the 6-month SORA. Okay, As I mentioned, the SORA, I guess a lot of you will be familiar with this SORA benchmark. Okay, so we would be looking to compare our performance for this fund against this number. At launch, Class A, which is the retail class, will be available. Class B, if you come in with more than $500,000, that's Class B, which would basically have a lower management fee, as you show here. The management fee for Class A is 0.63%, Class B is 0.33%, meaning that if you're able to come with a $500,000 at one go, then you can actually come into this Class B, which has a lower management fee. And therefore, what that means is a higher net return for you. Okay. Now I will go on into the attractive features about this fund. Okay. These are 5 points. I'll go over them one by one. Firstly, on the return part of things, attractive yields in the short duration space. Why is that so? Firstly, if you were to look at say risk-free government bonds, right? Singapore government securities, Singapore government bonds, you will appreciate the current high interest rate environment we are in. Because as recently as 2 years ago, it was nearly 0%, right? As you can see here, the middle part of this curve. Right now, that number is more like 3.7%, 3.8%, okay? So even for Singapore government bonds, this is what you can expect to get by holding it, okay? In terms of the coupon rates. Bond yields and interest rates are now much attractive than before, basically. And that's the reason why it is attractive to go in at this point. Second chart that I'm showing here is basically a different perspective, where what I'm showing you here is for Singapore government bonds over a range of maturities. So for example, on the left-hand side, you can see that for 1 month Singapore government bonds, you're able to get something like 4% interest rate, 4%, okay? 4% coupon, basically. And then on the right side, the extreme right side, for 20-year government bonds, you are only able to get 3.2%. This is what we call as an inverted yield curve. Inverted yield curve means that the short-term bonds actually have higher yields or higher coupon rates compared to longer-term bonds. And this is actually, I emphasize, it's not a normal situation. Normally, is the normal yield maturity curve is actually upward sloping, meaning that the short-term bonds typically have lower interest rates or coupon rates compared to longer-term maturity bonds, right? And if you think about it, that makes sense too. In the normal case of things, you would expect a higher coupon rate for locking your money into a long-term bond, say 20 years, where you only get a principal back after 20 years. You would therefore expect a higher coupon rate, right? Compared to if you just put into, say, a 1 year or 6 month kind of a bond, the coupon rate you wouldn't expect to be compensated that much compared to a longer term, because you're only locking your money away for 6 months or locking away money away for 1 year, right? But in this current environment, this inverted yield curve, this is why the sweet spot is actually in the short maturity part of this yield curve. And this is the part where it's highlighted here in the gray rectangle here. It is the segment that this sustainable reserve fund, or which is a short duration bond fund, it is actually going to invest into. Yep. And this is why the in terms of returns, it is quite attractive as an investment. Low volatility or low risk investment option, right? That's the second point. And for that, I will look to show here the interest rate risk, right? And the best way to illustrate interest rate risk is by showing several instruments that invest into different maturities or short. So basically, what I'm showing here is a range 5 ETFs from in the US market. that invest into treasury bonds. Basically, they face the US government, right? Treasury bonds. But the black one, for example, invests into 1 to 3 year treasury bonds. That means very short term treasury bonds. And all the way down, you will see that the green one invests into 20-year treasury bonds. Basically, it's a very long term treasury bond exposure. And in a year like 2022, where interest rates in the US rose from below 1% to over 5% and above, you can appreciate the interest rate risk that each of these 5 instruments here was subject to, and their performance subsequently. So you can see, for example, the most extreme one, the long maturity, ultra long maturity treasury bond ETF, which is shown by the green line. So this ETF, this bond ETF actually dropped by 30% within the year 2022 alone. So that's tremendous, right? 30% loss on a bond ETF is extraordinary. And the reason why was just simply because of interest rates, basically, right? It wasn't because of credit risk, because US treasuries are regarded as zero credit risk, right? Basically, so it's entirely because of interest rates, and because interest rates, um, the prices of bonds move inversely to interest rates. So when interest rates rise, the price goes down. But the interest rate risk for a long maturity bond is much higher than that for a short maturity bond. So you can see here that as in contrast to the green line, which shows the long maturity bond ETF performance in 2022, the black line at the top, which basically is investing into short duration treasury bonds, 1 to 3 years. So how did that perform? It basically just dropped less than 5% over the year 2022, right? So basically, interest rate risk rises with bond maturity, right? This is what we are trying to illustrate here. And that's the reason why the Sustainable Reserve Fund, being a short duration bond fund, we would characterize it as a low volatility or low risk investment option. Okay. Track record of one of Singapore's largest fund managers. So basically, Phillip Capital Management have been in money market funds, basically, which are also a kind of a very short maturity bond funds. We have been doing that for many years, right? We have actually run, for example, our Phillip Money Market Funds, which is one of our flagship funds. It's been running for 23 years. And we have had a record of zero credit defaults. And because we have been a long-term market participants, we have established a robust credit assessment process. And we have also established many relationships with broker dealers who offer private placements for bonds, and who are also willing to give us better yields because of the relationships, and also because we are institutional investors as compared to retail investors. Just as a comparison, the performance of the Phillip Money Market Fund over the global financial crisis is shown by the green line here. Our NAV, or the fund price, was able to rise consistently over a very stressed period, such as the 2008 to 09 GFC. Right, it was basically rising all the way to NAV. Fourth point, allows small investors access to short duration bonds with diversification. Now, at this point, I would just talk about some of the options that retail investors typically would consider when you want to manage your cash, right? Because I think people would tend to question, why don't I just buy a corporate bond myself, do DIY? Okay, so DIY option number one, I just buy into a corporate bond from a bond platform. There are some bond platforms available where you can buy some bonds. Well, that is one option, but what is missing is diversification, right? Because, for example, if you wanted to buy a bond with attractive yield, typically they come in, say, pieces of $250,000. And basically, if you don't have that much principal or money, that means you probably can just buy a few bonds at the most, right? One or two bonds maybe. And that doesn't give you diversification. What that means is basically if that particular bond defaults, the issuer doesn't have the means to pay or is unwilling to pay you back, then basically you'll be screwed, right? Basically, um, uh, you you also have another possibility, DIY option number two, which you may want to buy into a subscribe safe. Nowadays, it could be quite popular. Singapore government securities or Singapore savings bonds, right? You can subscribe to that easily. And for that, um, you can rationalize, oh, I don't mind putting all my money into SSB or SGS, right? You can subscribe to that, but you don't have credit risk because Singapore government basically, right, zero credit risk. But but the problem with this is that basically you're locking your money away for 6 months or 1 year. Say, if you buy a 1 year SGS, you're locking away for 1 year. If you buy a 6 month SGS, locking away for 6 months, right? Uh, Singapore savings bond, you are able to redeem at any time, right? That's the good thing about that. But I guess the yield is not that attractive nowadays. Um, and on top of that, you may not get the allocation that you want. You subscribe for, say, 100K, you may not get 100K, for example, right? The subscription rate is also a risk, right? So that brings us to this fourth advantage for the Sustainable Reserve Fund, which is it enables instant and easy access to the short duration bond funds, to the short duration asset class, right? First of all, you don't have the problem of the diversification part, which I talked about for DIY option number one, because the fund itself is able to buy a selection of bonds within the portfolio, so that ensures diversification. Secondly, it has economies of scale because it will be, say, 5 million, 10 million or more in terms of the assets under management. So we are able to buy, um, uh, 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 we are able to, through our years of market access, we are able to negotiate better yields. We are able to have access to bonds which are not available to retail investors like you. Okay, so that's the second advantage. And thirdly, daily dealing, meaning that the fund is available for you to redeem from any single business day, which is an option that is not available for you if you say put your money into fixed deposits, or you put your money into say 6 month or 1 year government bonds, or yeah, for example, right? So that is the advantages of a fund of this particular unit trust structure, basically, as compared to DIY option. Uh, I will talk about the last one, which is about ESG risks, right? And that is important. And the reason why is this, because this is probably as I mentioned, the only short duration bond fund that is an ESG fund as well in Singapore, right? So this is something that sets us differently from the rest. Um, so basically, this fund is an ESG retail unit trust, and what that means is basically you will be investing at least 70% of the fund into investments that meet our ESG criteria, right? So we do have some flexibility that up to 30% of the fund can be into other investments that may not meet our ESG criteria, but at least 70% must be into ESG, relatively good ESG scoring investments, right? And is if you were to look at it, not just from the point of you want to make an impact with investments, but as I explain later, it's also a way to screen for issuers that are future proof from an ESG point of view. And because the ESG or sustainable trends are so strong nowadays, it is important that you have an additional screening as we are undertaking for this fund. So first of all, this slide is trying to show how our sustainable reserve funds expected investments portfolio will compare with two other short duration bond funds already available on the Singapore market, which are not ESG funds per se. You will see that in terms of the financial and credit criteria, the portfolio parameters, they are relatively comparable. So for example, the Sustainable Reserve Fund, the credit ratings, all three funds are expected to be looking mainly at investment grade bonds. Okay, so similar on that. Secondly, in terms of the exposure, in terms of the maturity, a very average maturity of the bonds or average duration of the bonds that we invest into, roughly similar, between 1 to 2 years. Okay. Thirdly, in terms of the expected portfolio yield before fees, we are expected to be at 5%. So it also compares reasonably with within the range of the other two funds A and B. What differs is the last ones. So for this, we split into two rows. One row, the second last row, is basically those where the bonds or the issuers in the portfolio are considered high risk according to Philip's ESG risk rating. We actually have a data platform where we can run it through the data platform to check whether it's the issuer or the bond itself happens to be high risk or severe risk. Okay, and the last row is basically where through this same data platform under us, the issuers have no relevant ESG data. And why do they not have relevant ESG ratings data? It may be because the issuer chooses not to release a lot of ESG data about its operations, which is why the ratings system is unable to rate them, right? It's often this is the main reason why. So if you were to look at these two rows combined together, so Fund A, 24% plus 13%, that's about 37%, where the ESG, the ESG status of the portfolio holdings are doubtful, basically, put it that way, doubtful, okay? Either they are explicitly high or severe ESG risk, or they don't have ESG relevant data, right? So that's why I add both together, 24 plus 13 for Fund A, that's 37%. For Fund B, that number corresponds to 36 plus 19, that's 55%, okay? Now for the Sustainable Reserve Fund, because we are an ESG fund, so we are required to basically have less than 30% into issuers that are of high or severe ESG risk, basically. So that's the way to interpret lah. That's actually what I would like to emphasize. Is a distinguishing feature of this short duration bond fund compared to other short duration bond funds of the market. Yes, so this is just our sustainable investing position for Philip Capital Management, Philip Funds. We look to apply our responsible investment principles, purposeful investments with safe returns. And at the same time, we look to achieve our fiduciary, societal, environmental responsibilities, right? Now, but if you look at our philosophy in more detail, right? Our position is about accessing the double materiality impacts. So what basically that means is that we are trying to assess how external factors such as the environmental factors affects the company itself and its operations and its financials. And at the same time, so that's one materiality. The second materiality is about the company itself, how it, through its operations, how it affects the external environment, for example, right? So the long and short of it is basically our focus is not just about ensuring that the company doesn't pollute the environment, but it's also about trying to ensure that this company is run responsibly, such that it is its financial risk that comes from external ESG factors that is managed well, basically. So that is basically the financial part of this, and it's important. In other words, right, ESG is our ESG approach is also about ensuring that the long-term risk from ESG factors are managed by the underlying investments of the fund well, right? So that's what it means. It's not just about trying to ensure that these companies are very green or whichever, right? But it's also about ensuring that the financials of that basically the investments is long-term uh, long-term sustainable, right? Okay, from a financial point of view as well. Okay, I won't go through some of this, but I will uh, recognize this point. Okay, that's from an ESG point of view, we recognize that Singaporeans, Singapore investors, when you do investing, and you might invest into an ESG fund, but basically, you also want to do well financially through the investment, besides also hoping to have a positive impact on the environment through that fund, right? So that's why I say here, Singaporeans who adopt sustainable habits are primarily motivated by personal practical benefits, right? You want to live a sustainable life, you eat less red meat because it's for health reasons, not just because you want to save animals, right? Okay, so we are practical people, and we recognize that as well. And here I'm trying to illustrate that ESG integration into our investment framework, which is what we do for this sustainable reserve fund, it actually helps to identify and mitigate various ESG related risks where it's not apparent only through the traditional financial metrics. So all fund companies, they would access their investments always through a financial lens by assessing, say, the debts, the leverage, the ability to their track record, the financial track record. All these are the financial metrics, right? But we also, of course, we also do that for this fund. But at the same time, we apply an additional lens of ESG screening. And these are important because, for example, poor environmental practices lead to fines or reputational damage if it's not managed well, right? So that's what we are trying to assess here through an additional ESG screening, right? And the third point, companies that prioritize ESG, they are well positioned to tap into growing markets. So ESG itself is also an opportunity for companies to grow new revenue sources. Okay. And then regulatory compliance, of course, nowadays the authority, the government authorities, they are also focused on penalizing and incentivizing equal measures for poor ESG and high ESG scoring companies. Okay. Here I will give some examples, case studies for you to appreciate how ESG, a focus on sustainability in a company's operations, actually helps the company financially, right? That's why I put it as positive impact on the bottom line. Bottom line meaning the financial bottom line. Firstly, Mapletree Logistics Trust. So you will appreciate here that Mapletree Logistics Trust focus has been on their buildings to enhance their buildings such that they are sustainable. Sustainable from what perspective? Firstly, from solar systems installations on their rooftops. to increasing their water efficiency of the properties, and thirdly, attaining green building certification. Right. So what is the positive impact? So, for example, selling excess solar energy that's generated from their solar systems back to the grid actually helps to contribute to their revenue. Uh, Upgrading water efficiency, you can straight away appreciate that improves it lowers the cost of using water, right, for their buildings. Green building certifications actually ensures that these buildings under Mapletree Logistics Trust, they are more cost effective. And at the same time, nowadays, environmentally friendly buildings are able to charge a green premium for their buildings, right? So that's from so this case study illustrates that an emphasis on sustainability actually helps to lower the operational expenditure on the assets of this company. Now we go to another uh, company, Citrium, which is formerly Sembcorp Marine. Now, its focus on sustainability in its operations, it has another kind of impact on its financial bottom line, because if you see the table, Sembcorp Marine's order book nowadays, it also includes orders for new product lines such as ammonia carriers, hydrogen carriers, which basically is to support emission-free shipping, CO2 emission-free, right? And also Sembcorp Marine or Ciatrium, it now has capabilities in wind turbine installation vessels, right? Renewable power infrastructure, right? And lastly, offshore deployment of carbon capture facilities, another kind of sustainable energy infrastructure. So basically, if you look at that, Ciatrium's net order book nowadays, nearly 40% of that is coming from renewable green energy and clean solutions, right? So this is an example of a company which is able to tap on ESG to find a new revenue source. OCBC, right? So OCBC's focus on ESG or sustainability is focused on providing sustainable financing to companies where which are targeting, say, renewable energy, clean transportation. Those are which are trying to pivot to sustainability. Right? So OCBC tries to improve or increase loans to these sectors. At the same time, for those sectors that they already lend to, those that are more polluting, such as power, oil and gas, and so on, they set decarbonization targets. So what is the positive impact? It is not immediately tangible in terms of the financial bottom line, but it's more on the risk perspective. For banks, obviously, their balance sheet risk is very important. And the risk of sectors that are not focused on long-term sustainability, the risk of that is going to rise higher and higher, as you will see in the next case study. And so basically, OCBC as a bank, its balance sheet being the most important to it, by trying to increase more loans to sustainable focused sectors and companies, it is able to, from a risk perspective, future-proof its balance sheet. Right. Second aspect is supporting inclusive economic growth, such as workplace programs for staff wellness and so on, a focus on family. So by supporting social goals, it helps to enhance long-term staff loyalty. So that's important too. Not immediately tangible financially, but nonetheless very important. Last one, why are companies that are not focused on sustainability, why are they going to see negative risks going forward? This is a chart that shows from the National Climate Change Secretariat Singapore, the cost of carbon that will be charged by the government to sectors that are emitting a lot of carbon, right? Carbon dioxide, basically, greenhouse gases. Currently, it's being charged at $5 per ton of carbon dioxide emitted. Now, if you move forward to say 4 years to 2026, 28, that cost is going to escalate dramatically from $5 to $45 per ton of carbon dioxide emitted. So imagine those companies that are highly carbon emissive. So that financial penalty, the cost of ignoring the transition to a more sustainable environment, that cost will escalate a lot in coming years. Okay, I've come to the end of my presentation, but basically so just to summarize, why a sustainable short duration bond fund? So basically, you benefit from the high interest rates at the short maturity end of the current inverted yield curve, right? And at the same time, short duration bond funds have lower interest rate risk, right? Why Philip Capital Management? So because we have a long track record of managing money market funds, which is actually rather comparable but lower down the risk spectrum by one step compared to short duration bond funds, right? And also, we are, as far as we know, the only ESG short duration bond fund. And ESG, you should look for it. You should consider it as a way of providing another layer of risk checks to the portfolio, right? In addition to the traditional financial metric screening, it also provides an additional ESG screening on top of it to future-proof your fund portfolio. So I have come to the end, and I think I might have just about 5 minutes to answer any questions that I see in the Q&A. Okay, so I think I will answer to the first one, how to subscribe to this fund. So it is available for subscription through the major fund platforms such as Philip Securities Poyon's platform. Okay, it's available for subscription like you would for a normal fund now, or you could approach your financial advisor if you wanted to have more advice on that. The returns, is it 4.2 or 5? Okay, so what I was showing there, the 5% portfolio yield. So that's, as I've emphasized, that 5% is before expenses. So after expenses, the majority of it is management fee, of course, of which I presented as 0.63%, right? So that's why I say the net yield after expenses is going to be around between 4 to 4.5%, right? Yes, so that's why you see 4.2% as shown in the Poyon's email, for example. Yes, so that also answers the third question, right? Fourth question, non-Sing dollar bonds, which other currency? So as I mentioned, so the fund is able, its mandate is also allows it to invest into non-Sing dollar bonds. And what other currencies? Well, I mean, one obvious one that we could invest into is US dollar bonds, right? That is likely one of the major other country currencies bonds that we might invest into. Okay, let me also check in the chat box. It's a retail fund, right? So that's in response to a question about, is this a retail fund or AI fund? It's a retail fund. So the just to reiterate, the A class is typically what retail investors will subscribe to. If I have to scroll back, right? So the class A. So if you wanted a retail fund that pays quarterly distributions, you should subscribe to class A this bracket this. If you want a retail fund that you don't need quarterly distributions, you subscribe to class A, ACC, stands for accumulating. And I also mentioned that there's a class B. That class B is a lower management fee, it's just 0.33% management fee, but you need to come in with $500,000 and above, right? This is called the so-called institutional class. I hope that is clear. Yes.
Thank you, Teck Ling, for your insightful presentation, and thank you everyone for your eager participation in today's session. We hope that everyone has gained some valuable insights into the possibilities that arise amidst a high-risk, high-interest rate environment. And before we wrap up, I'd like to let everyone know that I'll be sending up a follow-up email tomorrow containing more information about this sustainable reserve fund that Teck Ling has shared about today. So do keep a lookout in your inbox tomorrow if you're interested in exploring this further. And if you have any further questions or feedback about today's session, please feel free to drop us an email as well. So thank you everyone for your participation and support. Hope everyone has a great day and see you at the next webinar.
Thank you for attending. Yes.
Thank you.